Good morning, everybody. I hope you're over your turkey hangover. I know that it took me a couple of days, and then I made a pork roast this weekend to soak up the rest of the mashed potatoes. And now I'm on a pork shoulder hangover. So I am meat-free for the next few days. I have a organic broccoli in the refrigerator that will be today's meal. In fact, I'll probably have it right after this webinar. So I wrote an article, Retirement Income Options, Oversold Christmas Presents, and there will probably be a part 2 and a part 3 to this. But I wanted to focus mainly on ETFs today, so that's where we'll go. First off, I want to pull up the screener here for you. Let's go. There we go. And we will take a look at the stocks. I have the ETFs labeled blue and the stocks labeled red. And this is using the monthly chart, the monthly time frame, meaning that the measurements are made at the end of the month. A weekly time frame, the measurements are made at the end of the week. A daily time frame, end of the day. Hourly, end of the hour, so forth, so on. So what we see is a similar thing that we've seen for the last few weeks. All of the satellite stocks are incredibly oversold. Coinbase is oversold. Ginkgo Bioworks is oversold. And you go right down the list. Even some big companies, Intel is oversold. Teladoc, which I think the thesis there is that they have to get bought out, but I'm not really super high on them being a mega growth stock anymore. A lot of competition has entered there. Keep on going down the list. DocuSign, I think a lot of competition has entered the market there. Roku, I think a lot of competition is entering the market there. And because they're having a hard time with hardware partners, I think it's tough for them to compete with the likes of Amazon and Comcast, which also has hardware. And I think over the wire, you're going to see some things. I signed up for some streaming services this weekend because there were some specials. I canceled my Paramount Global, which I had through Amazon for $9.99 a month in taxes. It was like $10.53. And I bought their special for the year, and I got an entire year for, I think, $50. So if you're looking for Paramount Global, you get $50 for a year. I also signed up for Peacock, which I've never had before, for 99 cents a month for the first year. And then it jumps up to $9.99 after a year. I think between now and then, you might actually see some mergers and acquisitions activity with Comcast that might change the whole equation. I still think that they make a lot of sense to do a merger with Netflix, just like I think Paramount Global makes a lot of sense to be bought out by one of the big tech companies, Apple or Google. Keep on going down the list, and a lot of these are still super oversold. Jumia, Zoom, which has an interesting niche. Once it gets valued properly, and we might be there, you'll probably want to own Zoom. Because I don't know that they're going to get a lot of competition on the non-enterprise side. On the free side of the business, they will monetize that a little bit through their VoIP service and just enhance services so that people can pay a couple dollars to not have all the limits. So they still have ways to make money, and their enterprise side is growing, especially in the small business segment, which I'm very bullish on small business. PayPal, oversold. I think probably is undervalued if it's under $100. I'm not sure where it is today. $80. So this is probably undervalued by at least 20%. Do a quick chart for you. I have changed the way that I am notating this for everybody. That's probably bottom fishing. Oh, look, it bounced right off. Didn't even know that. Probably about there. So maybe up just a little higher. Doink, doink, doink. See how I did that? Here's the points where there was some resistance. So PayPal's probably at bottom fishing. And if you want to own it, I don't think you have a ton of risk. Look how it got support right there. Caught it again. The odds of it going below here, man, that would just be abysmally cheap. And I think it's oversold and undervalued where it is. We can see that the Elliott wave has been improving, and we can see that RSI improved off a bottom, but still hasn't broken out. So I think PayPal, you can buy the dips and really buy it if it gets down in here to the 40s and 50s. That would be pretty mind-boggling. Now, I wrote this article, and if you took a look at it, we do have the screener here. I just give the highlights. This is the last day for the 50% off at TradingView. And honest to goodness, the screener alone is worth your time. This screener will make you your money back on your first trade. Easy. Because just by using this and then taking a look at the different time frames will get you to the point where you can just cheat off of RSI. And then you take a look at the different indicators that I showed you, Elliott wave, things like that. I'll set up, I'll update. I will update my instructions on how to set this up so that you can follow along even closer. So we get into the options to sell. I'm in the process of updating these. I have a few left. S&P 500 dividend companies. Not a lot of these are worth selling puts on just yet. But then I got into, keep an eye on these. These are interesting already, the ETFs. And I'm tracking 207 ETFs, even though there's about a third that many on our global trends list, because I really want to keep track. RSI on the monthly time frame. You see all of these oversold ETFs, but you don't see SPY on here anywhere, or VOO. So none of the S&P 500 stuff. Right now, it's the emerging markets and international in general. It is the small caps, to an extent, the mid caps and the technology stocks that are beat up. The S&P 500 has not been beaten up, even though people will say, oh, such a horrible year for the S&P 500. That's bullshit. This is not a bear market yet for the S&P 500, at least not the end of the bear market. The bear market for the S&P 500 is really just getting begun. It hasn't headed to where it's going to head. It's going to head towards 3,000. And if we really get stagflation next year, even more than we already have it, S&P 500 is going to come down lower. Why? Because at some point, foreign inflows have to stop if the global economy goes into recession, which it looks like it's going to. So this idea that you should be in a hurry to buy things at the large cap end is wrong. You should not be. And if you think that you're holding on to some safer stocks because they're large cap, you're wrong again. You need to really take a look at the relative strength index for your large cap stocks and really truly consider, and you can use Stock Rover for this, if they are appropriately priced on a valuation metric. When we took a look at Stock Rover, and I'll put that in today's Stocks of the Week article because I'm almost done with that too, what you'll see is based on price to earnings ratio and free cash flow, virtually all the large cap stocks are fairly valued to overvalued. There's only a few dozen that are undervalued. And we have focused on those. Paramount Global, Warner Brothers Discovery. There are a few pockets that everybody hates, and they're wrong about that. If you want to beat the stock market, stop thinking like the stock market. If you want to chase performance, good luck with that. Because unless you're a shooter or you are following him really closely and taking the time to really try to understand the short-term movements, you're going to get creamed by supercomputers, by hedge funds with microwaves and infrared transmissions so they can skim every trade you make. They can cause support levels to break straight through the ground overnight, which they do all the time. Somebody showed me a chart of his with some clever little triangles on it. He didn't understand what those were. He just looked at the line and said, oh, that must be support. Well, the market keeps going up, but if there's a breakdown, we have seen elevator drops before. So when somebody tells me, well, I'm up at $5,000 in the last month, I kind of laugh. I try to tell them that they're gambling because they can't explain to me why it happened. And the answer is they got lucky. Just like the guy last night who busted me out on the final table in a poker tournament that I was playing while I watched the Packers put up a valiant losing effort and start the Jordan Love era. I got a pair of nines in against his pair of sixes. I'm 80% likely to win. He sucked out a straight on the river and said, I really outplayed you that time. Got you to get it all in. I'm scratching my head. I'm like, well, that's exactly what I wanted to do. I was an 80% favorite. Still lost. But he thought that he did a good job. He really did. He wasn't fooling around. I raised to make you bet. I figured you'd call me with overcards and I'd be a favorite. Well, I raised and he called me as an 80% dog. But he won the hand, so he was very proud of himself. We played that hand 5 times. Who's going to come out on top? And that's why I tell you, your competition when you trade starts with shooter, who's a bit of a savant. And then you go to the big institutional traders and the hedge funds. And the hedge funds lie, cheat, and steal, and they use Reddit to do it because they take an idea that they have piled into and then they pass it on to somebody who puts it on Reddit. Maybe there's another level of removal there. I don't know exactly how the cheating works. And then they generate FOMO. Gotta chase, 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 chase. They chase it all the way up because their pretty chart says to. And when it falls like a stone, because first the hedge funds sell, which creates the sell signal. Then the guys who are writing the blog sell, generates another sell signal that they put on there. This is what I just traded on. They all stampede through because, oh, look, follow through, downward momentum. Sell, 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 sell. And then the guy who's out to lunch looks up an hour later and is like, oh, Jesus, I'm down 35% on my option. And it just keeps falling through the floor for weeks. If you really want to trade, you would better be learning the technical indicators very, very well. But even if you just want to beat the market by a few points every year and be safer than it, you should learn the basics of relative strength index, kind of understand what the momentum levels are, MACD. These are some of the combined oscillators over at TradingView, and they're pretty good. You want to see them all kind of line up together. This is the aggregated oscillator rating. What you'll see is that all these stocks that are super oversold are just starting to flash buy signals. So the aggregation of everything here, there you go. And what one is showing a strong buy signal? It's the emerging markets, which I've been pounding on you about for a couple of months. As a long-term trade, these are super important. So let's go through some of them. Let's start at the beginning. First off, the small caps have been keeping up with the large caps for about 6 months now. SPY is the orange line. IWM, small caps, is the blue line. They're about even going back to spring. And there's been periods, like in the last couple of months, where the small caps have started to just outperform a little bit. But what we know historically is that when you come out of a bear market, and actually right before the bear market ends, the small caps really start to outperform. Now, I thought the end of the bear market was going to be the end of this year. And because the traders are stubborn and they still have enough liquidity, they've been fighting it. There hasn't been a capitulation yet. The things that normally happen at the end of bear markets have not happened yet. So we're probably not going to see a bottom in the large caps until the first half of the year sometime. And it won't just be tied to the Fed backing off a little bit, because when the Fed does back off, that's going to scare people. Oh my God, things must be getting much, much worse. And I do think there's a timing element here for the Fed. As I've told you, the first quarter is usually a slow quarter. And because we haven't gotten the capitulation in the stock market that the Federal Reserve told us 7 or 8 months ago that they wanted to see, they told us. Fed president after Fed president said we need to see stocks come down and asset prices come down, real estate. Stock market's not down that much on the large caps, which is where most of the money is. Real estate prices have only come down a little bit, mainly at that middle high end. You know, your upper middle class houses, your $400,000, $500,000, $600,000, $700,000, $800,000 houses have gotten beat up. But luxury houses are luxury houses and starter houses are starter houses. Granted, that's less than half the market, but 60, 70% of the houses have come off 10, 20%, which is not really that big of a deal unless you just bought that house a few years ago and are trying to flip it, or you're forced to move for work or something. I've been in contact with Open Door, and I'm pounding on Eric Wu to not sell the houses he's underwater on, but rather find credit-worthy tenants and sell and rent them the houses. And then I've told him, after you have them into a rental agreement, when it comes up on renewal, offer to finance them to buy it. Say, hey, you've lived here for a year now. Do you like it? Would you like to buy it? Let's work something out. We have $1 billion laying around. They do. And that's the way that you should be thinking if you're a very opportunistic investor is, Open Doors sitting on a mountain of cash. They've slowed down their home buying again. When they did it earlier in the year, they should have done it more. I told them to. They've ignored me so far. And now I'm telling Eric Wu, just be a good real estate investor. Don't think like some tech guy who's revolutionizing things. Nah, dude, you created an app. Great. Diddy did that too. Diddy's got an app for everything. If you don't know the reference, I apologize. But if you're going to invest in real estate, then use the full toolbox, which is when your real estate is underwater and you think that it's going to go up over time, and you have enough renters, which you do in this market, rent out the house. Get a good security deposit, credit card number, and rent out that house. Because in a year or two, you're back in the black, and you might even be able to act like a bank at that point. And there's more margins than that too. Why am I focusing on Open Door right now? Because there's a lot to that. Housing market's important. But if you think about investing from the standpoint of how can I make the most money with the least amount of risk, you use your entire toolbox and you say, well, what makes sense here? And what usually makes sense usually happens. It's very rare that something makes sense and somebody doesn't act on it. May not be the people involved right now, but things that make sense usually happen. Over and over and over again in your lifetime, you have said to yourself, I wonder why that's not happening. I wonder why that's not changing. A lot of times it has something to do with things going on in your city or at your job. I wonder why they're not doing this. I wonder why they, right, the all-powerful, all-knowing, all-encompassing they, aren't doing something about this. Why aren't they doing it a different way? And eventually they do. They comes around. And all these charts I'm about to show you, they are going to come around. So the small caps just starting to show signs of having a big breakout rally. They will bifurcate. They will split from the large caps soon. So let's take a look at the large caps. QQQ has crushed SPY for the last 20 years. Really, excluding the .com crash, QQQ has beaten SPY regularly over any extended time frame. I believe it's any 2-year period. Might be 3. Sure, SPY wins from year to year once in a while, but not very often. And when it does, that's just an opportunity to load up on QQQ again. So we have a couple of charts. We have a couple of lines here on this chart. Red line is support. Purple line is the potential broadening wedge. It's just kind of a baseline going back to that 2016 period when I said basically that's the support for everything. We could get down there in the Armageddon zombie apocalypse, but not likely. Here's your Jeremy Grantham zone, right? If it breaks through this support, you get into that Jeremy Grantham pop all bubbles range. Now, the way the world is going, we are seeing a reduction in globalization. If you're watching what's going on with Apple in China, what you realize is that probably Apple should only produce the phones that it sells in Asia. They should produce the phones they sell in North America in North America. They should produce the phones they sell in Europe, in Africa. Because of artificial intelligence and machine learning, it's no longer necessary to try to capture the labor arbitrage like it was back when so many things were made manually. Today, I sent a message to the Wisconsin governor, Tony Evers, and Tim Cook and Apple in general. I said, hey, and as I attached it to a Bloomberg article, why don't you guys start making iPhones in Kenosha, Wisconsin? We have a Foxconn facility that's underutilized, and it's close enough to Corning that the glassware can get here, or whoever's making their screens now, because there's glass facilities in the Midwest. Not close enough to do big screen TVs because those will break in transit, but the little pieces, yeah, they'll be okay. And that's what's going to happen. It might not be Kenosha, Wisconsin. Maybe they'll be dumb and put it in Arizona and then realize, oh my God, this is getting expensive because of the weather. Maybe we should go where the water is, and the air is, not 130 degrees in the summer. We'll see. Intel and Ford have figured it out. Other companies are filling in that corridor from Chicago to Milwaukee. Pretty soon it's going to be from Milwaukee to Green Bay. That'll be the next 20 years. Kentucky with its river systems, Ohio with Great Lakes, the western part of New York, Indiana, northern Illinois, Minnesota, Michigan. These are all places that Nouriel Roubini said you ought to be buying real estate in, not places that are going to be flooded or so hot that you can't live there. And when you take a look at QQQ, you have to think about if there's not a Great Depression coming, and this is going to be my first article of next year, maybe it's a great divergence. Maybe what we're seeing is what Kirk talked about in some interviews a few years ago when he said to sell your old man stocks, because if they don't play into the decarbonization and 4IR and technology and digitization themes, all encompassed by the demographics of the world, where it's aging and where it's not aging. I mean, everything's aging, but certain populations like India and Vietnam are pretty young versus Japan, China, Europe, which are really old or getting really old. And the United States, which is kind of staying even because the millennials are offsetting the boomers. Got to wonder what it's going to look like in 30 or 40 years, though. Will the millennials end up having enough children to replace themselves? Looks like it's going to be close. I'm seeing a lot of 2 and 3 baby households among the millennials. And I don't know if that's everywhere, though. The numbers seem to say that they're almost having 2 kids per couple. But, only 60 or 70% of them will form households where they have babies. So how is QQQ going to look in the future compared to SPY? When we think about these demographic things and these major secular trends, I think the divergence between QQQ and SPY is going to be bigger than it has been in the past. So if we take a look at QQQ and SPY, We pull it all the way back 2003. So right after the dot-com crash. We take a look at this huge divergence. Look how much more QQQ is up compared to SPY. 3 times as much. Until SPY pulls in another 100 tech-savvy and tech-linked stocks, which is going to take the better part of a decade. I think QQQ in the next 10 years could make double what SPY makes. The chart I just showed you is a triple over 20 years. I think it'll be a double over 10. That's a pretty big upgrade. 72% compounded is what gets your double. 115% is what gets your triple. If QQQ triples SPY, it won't take 20 years again. It'll take more like 14, 15, 16 years. And that's why QQQ needs to be your core holding. And something like QQQ needs to be your core holding in your 401k. I bring up the 401k just because people ask me about it time to time. I think that your 401ks usually will have a large cap growth fund, even if they don't have QQQ. Now, the 401k that I'm offering the small businesses and mid-sized businesses actually has QQQ in it. And we're saving the companies that I'm putting into this new 401k run by a fintech company something like 50 to 60% on fees. It's all money that goes to their bottom line, and they get better 401k sub-account selections. For you, if you have a 401k right now, as this correction is going on, and before SPY completely collapses, you need to get out of your S&P 500 funds. If you just move laterally to a large cap growth or to QQQ, if they have something like it, or a Fidelity Technology Fund or whatever's in there, just move laterally. Even if you take losses in the short term, you'll do better in the long term. Could try to jitterbug it, put your money in cash, and then trickle it in over 3 or 4 or 5 or 6 months. Better be diligent if you do that. QQQ looks like, pull this back to our standard baseline area, which is 2016, that I've been talking about for a very long time. And we can see that the support levels are somewhere in this range. 230s down to 2 teens. Got this support line. And I think SPY will break through its support line, but I'm not so sure QQQ will. Is Apple going to get knocked here? Yeah, and that'll pull it down. But Google, Amazon, Microsoft, they're all pretty beat up as far as they go. So if you see QQQ drop 10%, that'd be about 250 something. Another 10% would be down here. So you can see QQQ drop about 20%, get in this range. I think it's pretty strong buy down there. Can it get into the Jeremy Grantham zone? It can. I don't think it would stay there long. SPY, on the other hand, I think can take a long time to recover because there's so many old man stocks in SPY, and they're so slow to replace them that the gap between SPY and QQQ that I just showed you is going to keep growing. This fund basically mirrors QQQ. iShares Evolved US Technology. Same story. More stocks, a little bit more diversified than QQQ, and it essentially tracks it. For small accounts, I like this a little bit better than QQQ. You can have a trading position in QQQ, but I like this one. I like IETC. It's just a little bit more diversified option. Look how close they track. They're pretty darn close. It's just a slightly less beta for you. But QQQ is fine if you don't want to use IETC. It's just for people who want a little bit more diversification. There you go. XMMO, which is the mid-cap momentum fund. Take a look at that chart. That's pretty up and to the right, isn't it? That's what you look for. And remember, this is a momentum fund. So it shuffles every month. It shuffles its fund holdings. In fact, it's actually their major reallocations on the semi-annual. So they're looking for the stocks that have outperformed over the last 6 months because they tend to continue to overperform. Compare this to SPY and QQQ. So QQQ has beaten it since 2014, and we can pull this back to 2016, but not by much. In fact, XMMO, which is the darker blue, since 2016 has outperformed by just a hair. So between QQQ and XMMO, you're going to beat the hell out of the S&P 500. And again, people want to say, well, it'll reverse. No, it's not. These are the better companies. XMMO focuses on relative strength. QQQ just has the better secular trends embedded in the index. They have less old man stocks by nature of being mid caps and by being tech heavy. Your old man stocks, which die like old men, are in SPY. That's not the whole thing. It's a solid 100 to 200 companies that when you take a look at the fundamentals on a screen from Stock Rover, you're like, oh, I get it now. Lower growth rates, higher debt is bad. So what are some of our other core holdings? First Trust NASDAQ Clean Energy. It's basically large cap clean energy. And then Invesco Wilder Hill Clean Energy, which is basically mid cap and small cap clean energy. I don't really use Q Clean because it's Tesla heavy, and I can get Tesla and some of these other funds, QQQ, but it's held up pretty well. I like this one, PBW, because I like small and mid caps. I think that's where we are in the cycle. And I think when this roars, it roars bigger. So if we compare it to Q Clean, right? All investing is relative performance investing. And let's go back to COVID. Q Clean is outperformed. What is this on the back of? Oops, Tesla. Tesla is a bigger holding than Q Clean. So Tesla has pulled this up. I can get Tesla and QQQ. I don't feel like I need it here. You can use it, and especially if your QQQ position isn't going to be as big as I think it should be, go ahead and use it. Let's actually take a look at this on a shorter time frame, just 1 year, right? Q Clean is still beating it. So that's the argument for using Q Clean. Crossed over here again. There was a period on the downside in a choppy cycle where PBW outperformed. But again, I can get enough Tesla and QQQ. I think that Tesla is fully valued even at 600 billion. I thought it was overvalued at $1 trillion. I think Tesla is going to be choppy a long time. And I think there's a lot of opportunity for small caps to get bought out and to fill a lot of the gaps in the energy system. That's me. For most people, you probably ought to have both. Emerging markets. About a month or two, I was screaming at you to buy this fund. It's had a little pop. But on the mini revolution in China, right, the airing of grievances, their Festivus, maybe this pulls back a little bit and you get another chance. I think you do. I think there are some options that you could sell if the market was thick enough. Tends not to be. So you may just have to buy some of these because there aren't great option markets. TLT got into our buy zone, has had a rebound. I think it's going to come down again because I think the Fed is going to be mean again. I could be wrong, and we're going to find out. I think Powell's talking today or tomorrow. We'll see. If the Fed is mean again, this has another leg down. I'm not sure what Shooter thinks about that. But if Shooter wants to type something in, I'd be happy to repeat it or pull you on the air. Now, here's the one that I really think is interesting. The emerging markets debt. You can see nice uptrend for a long period of time, right? We always kind of discount COVID. That's a great chart, right? And look at that. It's going back a decade up and to the right. And here we have a big correction on the strong dollar. Dollar weakened in the last couple of weeks. You get a spike. If we get one more strong dollar moment, and you can buy emerging markets debt down here, see where these support resistance levels are, and you can buy emerging markets debt down here. Not only do you get a big income, but you get a resumption at some point of this trend. So emerging markets debt is super interesting to me. If you've been following along with Goldman Sachs and Morgan Stanley and Nomura and some of the other big investment houses, there you go. TAN, we need more correction here, but solar is just such a fast growth thing that as they become profitable across the board, and a lot of them already are, if we especially if we get something down here, we get this area down here on end of the world stuff. Oh, what a great buy. The weed stocks, I think, have basically bottomed. Long-term investors, you can sell options there where there's a market. Arc Genomic Revolution, look at that. Doesn't mean there can't be another leg down. Semiconductors, which are the brains of the world, man, if it gets down into here, what a wonderful buying opportunity. The options aren't, there is a big, robust options market, but nothing priced well yet. It has to come down again. XLE, didn't quite hit my target, but look how close. Told you back here. Now it's coming down. You get XLE, low 80s, probably going to want to buy it. Because the disruptions out of Russia, I just don't think are getting better anytime soon. Although the minute Putin is out, you got to be very cautious about your oil longs as a group and just focus on your very best picks like Occidental or Chevron I said Chevron or Permian Resources. Exxon has a problem in the Permian, by the way, if you missed that. Now, somebody asked me today in the chat, do I have any small or mid-cap infrastructure plays? My infrastructure plays are actually mainly large cap because they win most of those contracts. There's probably a widget maker of some sort out there that I should be aware of. I haven't found it. Bring me an idea and I'll look it up. But I like Freeport-McMoRan, you know that, if I can get it at the right price. Was talking to somebody who is involved in laying transmission wires, and he said, look, man, we can't get the steel, we can't get this, we can't get that. So the metals companies that can control their costs and take advantage of a widening margin probably do well for a while. So Freeport-McMoRan, I think you could take a look at a couple of the steel companies, but again, it's price dependent. Just because the business does well doesn't mean that it's not already priced into the stock. American Transmission is owned by essentially Wisconsin Electric. That's what I call it. WEC Energies, WEC Energy Group. And that's a heck of a chart, right? Up and to the right, they pay a big fat dividend. Why do I like this utility company? Because it owns 60% of American Transmission, which is integral to rebuilding the grid in all of flyover country. So I really like these guys. One of their executive vice presidents came over from American Transmission. So they are very integrated here. American Transmission is what gives this utility, otherwise a boring company, a lot of juice over the other utilities. It's a long-term chart, right? Go even further back. Holy cow, right? Take a look at that. That is a nice chart. So you can buy that down here in this buy zone or sell puts. There you go. Somebody asks, I don't know why people don't sell options on real estate. Well, that's why I said here, some of these, right? These are all pretty much real estate plays, except for the energy companies, right? You have these REITs, KKR, Blackstone, very heavy in real estate. I think selling puts on real estate, if I could do it on houses, I would do it on houses, right? If there was an option market on real estate on houses, really the only way to do it is through private equity right now. I would do it. You've heard me talk about real estate investing for years now and how to do it the right way. It's very cyclical. You have to take advantage of that. You have to find the growing markets. You know, people who invested in Southern California 20, 30 years ago did well. I think people who invest in the Midwest over the next few years are going to do really well over the next 10, 20, 30 years. Again, climate change related and supply chains moving related. A lot of skilled labor here, a lot of warehouses that can be filled, a lot of industrial parks where there's a bus run into it to get the people to work there. There's a lot of industrial parks. I mean, that's who I'm selling 401ks to. Companies with 30, 40, 50, 60 employees. And they make a widget or they make something for the semiconductor industry or something for the car industry. It's all made in the Midwest. And there's water. There's a little bit of winter. Kills the big bugs. I really like the idea of selling puts on Vici. Digital Realty Trust, I think, is getting to be undervalued at this point. And it's been a long time for this one. AMT, American Tower. A couple of reasons why we like American Tower. One of them is the infrastructure bill, right, which wants a lot more 5G built in the country. So between their connection to AST Space Mobile and the fact that the government's telling them to build more towers, giving them money to do it, hey, there you go. So selling puts on some of these could be really interesting if we can get close enough to a bottom fishing price. So we don't have to get all the way to the bottom fishing price. We can sell a put that gets us to the bottom fishing price. But I do think there's more weakness to come. Don't think we're there yet. And I think the Fed can smell the victory that they're looking for. And the victory that they're looking for is to get asset prices back to normal valuations. I think it's unlikely we see a lot of undervaluation at the large cap spot, but I think a lot of things will get undervalued. I think small caps are undervalued. Real estate may or may not get there. Certain real estate will be a slow bleed on certain commercial properties that people have false hope about, right? So last night on my Facebook page, I asked people, if the Packers win tonight, how much false hope for the playoffs will you have? And there were a few people who were believers. Packers ended up losing, so it was a moot point. But the Packers are so hurt and so lacking on offense that even if they had won last night and run the table and got into the playoffs, I wouldn't have been too high on them. Well, people do that with real estate because they think of it as one big asset class. And really, it's about a dozen asset classes, right? A dozen industries within one sector. That's how you should think of it. Different types of commercial real estate, different types of industrial real estate, right? Storage real estate is considered industrial, but it's really kind of its own thing. So store, which is commercial, versus stag. Well, stores, I think they might not exist anymore because they got bought out. But your mall REITs, your industrial REITs where they build stuff inside the building, your storage REITs, there's lots of different classes, your tower REITs, right? So there's different subcategories, sub-industries within REITs, and you have to split them out because a lot of them don't overperform. Only a few of them overperform versus the S&P 500. But if you get in there at the right prices, boy, can you make a lot of money and get an income kicking off at the same time. I think that if we get mean fed one or two more times, that could be really neat. And if you have cash in the bank, right, if you're one of those people that like to get up to the $250,000 limit for FDIC insurance and you're over it maybe, I would take a look, actually buying some real estate near you. Or if you want to get in the Midwest, let me know and I have the connections. I think there's some interesting real estate opportunities that could develop if, in fact, we get another whiff of stagflation. If China, Russia, Saudi Arabia don't play nice, if something bad happens with Iran, if Europe just can't get it out of its own way and find a way to right their ship, and I don't think they can. I think Europe is going to be in trouble a long time. If the Fed is mean, there's a lot of things that are going to drive large caps and real estate down another big leg. So don't be anxious to buy. Let it come to you. Any other questions? Somebody asked about BST and BSTZ. Like them a lot. I think if you are a retiree, let's just start over here. This is the easiest way to do this. Big support comes in there. Middle 20s, I think, is probably where you can take a look at BST. End of the world stuff is down here. We at the Z. Remember, BSTZ has more private equity and small caps. Start over. Oh, look at that. I mean, it happened. Yeah, BSTZ, I have to take a look at the holdings because I don't know. Let me take a look at the holdings here the best I can. This is kind of a hard fund to research because they're a little bit opaque about what they own. Remember, it's not an ETF. It is a closed-end fund. Let's talk energy here to finish up. AMTX, I think, is one of the screaming buys in the market right now. They're at bottom fishing. So I understand that people don't understand this company. It's not my fault. I've explained it enough times, and it's very easy to go to their website and figure it out. These are some big rallies and come downs. I think this is probably as low as it goes down here in the 3s and 4s. Shooter, I think, has a chart out there somewhere which basically pointed to this getting down here in a worst case scenario. Lower liquidity. People are impatient about the earnings, which aren't going to show up for a couple of years. They are roughly breaking even actually, but people want to say, well, it's not profitable right now. And they never look at the crossover between earnings, revenues, and CapEx, right? Revenues and earnings go up on one direction and CapEx comes down the other direction. They cross. And that's going to happen in the next couple of years. Enovix. So let's finish with this. Let me pull this up real quick. ENVX. If you were an investor in Enphase with me several years ago, same CEO is involved now, right? TJ Rogers stepped in at Enovix, went from chairman to CEO, I believe is how it went. But in any case, you need to read this article by this guy, different guy. This guy is TJ Roberts. And TJ Roberts is down in Florida, and he is actually in the industry as an installer, owns his own firm, I believe is what the deal is. And he's just sharing articles, what he knows from the industry as being boots on the ground and what he's investing in. And the problem of thermal runaway with batteries seems to have been conquered by these guys. They've got to deal with the government. They got to deal with some car companies. And they use silicon to solve the problem with a type of design that has worked. The upside for this company, and remember, they manufacture something, so they're CapEx sensitive. But the margins and what they're going to do are going to start probably in the 50s, and it'll come down to the 30s over time. And people will moan about that. But at the same time, the revenues are going to skyrocket because it doesn't look like anybody's within years of being able to do what these guys are doing. But I've told you in the past, 2-3 years ago, right, CES 2020, the silicon was going to end up being a big deal in batteries. They just had to figure some things out. Well, it looks like these are the first guys to figure it out. So they can make a battery that's almost twice as good as lithium ion, and it doesn't explode or catch fire under certain circumstances, right? That's the big problem with lithium ion is it's still every now and then you can make it catch fire. These guys seem to have solved that by using the silicon as the anode. So if you like small caps with 10x plus potential and you can hold on to your Wheaties through the volatility, and the short pieces and the negative hits, and just watch for execution at the company to give you your signals, not the people who are just giving you the day's traders narrative, then Enovix is probably for you. Like a lot of the other small caps I've got you into. Huge potential. Some of them won't work out, but the ones that do, according to Peter Lynch, give you a lifetime of performance. All right, let's call it a day. I'll get this edited this afternoon. And yeah, I hope you all had a great Thanksgiving. Next week, I will be in New Orleans Tuesday through Sunday, and I will actually take a few days off. I'm undecided about whether there will be a webinar next Thursday. My guess is no, so I'll probably take next Thursday off, but we'll have a webinar on Monday. All right, everybody, take care.